I recently found myself staring at my investment portfolio, feeling like I was lost in a maze, blindfolded, so many options, so much jargon, and honestly, a good dose of fear of making the wrong move. Sound familiar?
It does.
Well, that's precisely why we're taking this deep dive today into The Intelligent Investor by Benjamin Graham. We're talking about the book on investing, the one even Warren Buffett swears by.
Ah, yes, a classic.
And our mission, to unpack Graham's timeless wisdom and give you actionable strategies for building a resilient portfolio. We're cutting through the noise and getting straight to the good stuff.
Excellent.
What's fascinating about Graham's approach is his clear distinction between investing and speculation. He argues that understanding this difference is crucial before even thinking about putting your money on the line.
You're right, it's a fundamental starting point.
Okay, so let's break that down. He's essentially saying investing is like building a house on a solid foundation, carefully analyzing a company's value and aiming for steady, long-term growth. Absolutely. It's about understanding the business, its intrinsic value, what it's truly worth, and buying it at a price that makes sense. It's not about chasing quick profits or riding the wave of market hype, which is more akin to speculation.
So instead of getting swayed by the latest hot stock tip, we should be thinking like business analysts, digging into financial statements, understanding a company's earnings and its potential for future growth. Precisely. And this is where capital preservation comes in. It's not just about making money, it's about protecting what you have. Think of it like this. You wouldn't build a house on sand hoping for the best, right? You'd choose a solid foundation. Similarly, in investing, you're looking for those companies with strong financials, consistent performance, and a solid track record, not just the ones making headlines this week.
That makes a lot of sense. It's about thinking long-term and choosing investments built to withstand market fluctuations, just like a well-built house can withstand a storm.
And speaking of weathering storms, that brings us to Graham's concept of margin of safety, which acts like a financial buffer zone.
Margin of safety. I'm intrigued. Tell me more.
Think of it as a built-in cushion for your investments. It's about acknowledging that even the most thorough analysis can be imperfect. You're essentially aiming to buy assets at a discount to their intrinsic value.
So even if we make a mistake in our valuation, this margin acts like a safety net. How do we actually determine that margin, though?
It involves some homework, but it's not rocket science. A simplified method is to look at a company's price-to-earnings ratio, or PEE ratio, compared to its historical average or its industry peers. If the current PE is significantly lower, it might indicate an undervalued opportunity. But remember, this is just one metric, and a thorough analysis should consider various factors.
Okay, that makes it feel less abstract and more actionable. So let's say we've done our research, we've calculated our margin of safety, and we've found a potentially undervalued company. Then comes the tricky part, dealing with the emotional roller coaster that is the stock market, right? And this is where, if I remember correctly, Graham introduces his famous Mr. Market metaphor. Tell us more about this Mr. Market character.
Ah, Mr. Market. He's an imaginative way. Graham illustrates the market's often irrational behavior. Imagine Mr. Market is someone who shows up at your doorstep every day offering to buy or sell you stocks. Now here's the catch. Mr. Market is incredibly moody. Some days he's euphoric, overly optimistic, and willing to pay top dollar for your stocks. Other days he's downright depressed, pessimistic, and wants to sell you everything at a bargain basement price.
Okay, yeah, I get it, Mr. Market. Got a wild card, huh?
Yeah, exactly. He embodies the emotional ups and downs of the market.
And we're not supposed to let his mood swings, mess with our strategy, right?
Exactly. You've got it. It's all about, well, remember Graham's point. The market is driven by emotions, especially in the short term.
Right, fear and greed, that whole thing.
Exactly. Fear and greed, those are the big ones. And they can really cloud judgment.
So, all those crazy market swings, those surges and crashes, those are basically just Mr. Market having a bad day.
Pretty much, yeah. Well, they're driven by sentiment more than rational thought, you know? Remember the dot-com bubble? Everyone was so gung-ho about internet stocks, and then boom, reality set in.
Oh, yeah. And the recent meme stock thing, too, right?
Yeah.
That was wild.
Exactly. Classic examples of Mr. Market getting a little too excitable, and unfortunately, a lot of investors get swept up in that hype.
Yeah, they start following the crowd and forget all about their own analysis, their margin of safety, everything.
Precisely. And that's why Graham stresses staying rational. Tune out the noise, don't let Mr. Market's mood swings dictate your moves, Be a contrarian.
Easier said than done, though, right?
Yeah.
Especially when you see other people, like, making a killing. It's hard not to get caught up in the frenzy.
It's definitely not easy, requires discipline, a long-term vision. Remember, Graham's approach isn't about getting rich quick, it's about slowly building wealth, like laying bricks, one by one.
So we just need to ride the waves, be patient, and trust that over time, the companies we've carefully chosen will pay off.
Exactly. Buffett, huge Graham disciple, once said, "The stock market is a device for transferring money from the impatient to the patient." Words to live by, in my opinion.
That's a good one. So we've talked about identifying undervalued companies, calculating the margin of safety, staying calm amidst all the chaos. How do we actually put this into practice? How do we take all this and make it actionable?
Right, so we've talked theory, now let's dig into the practical application. Graham was really into what he called value investing.
Okay, value investing, so what's that mean exactly?
Imagine being like a financial detective searching for those hidden gems the market has missed, the undervalued companies with strong fundamentals, but haven't quite gotten the recognition they deserve.
Ah, I like that. So instead of just following the crowd, we're looking for those diamonds in the rough.
Exactly. You're getting it. It takes thorough research, looking beyond the surface, really understanding a company inside and out. Are they financially sound? Do they have a competitive edge? Is their management team solid?
And if the market price is way lower than our calculated intrinsic value, giving us that margin of safety we talked about, then that's a potential green light.
You got it. But remember, even with all the research and careful planning, there's no such thing as a sure thing in investing.
Right, there's always risk involved, no matter what.
Exactly. The margin of safety helps mitigate that risk, for sure, but it's not foolproof. That's why diversification is so important.
Diversification. So we're not putting all our eggs in one basket, even if it seems like a really promising basket, right?
Precisely. You're building a resilient portfolio that can weather the storms. One that can deliver steady returns over the long run.
So we talked about this long-term thinking, this patience in value investing, but how do we actually find these diamonds in the rough, these companies?
Well, that's where the real work comes in, right? You got to be ready to dig deep, scrutinize those financial statements, really understand the company's competitive landscape, their management, their potential for growth.
Yeah, and that sounds like a lot, especially for someone who's maybe just starting out. Where do we even begin? What resources are out there?
Tons of great resources out there. You've got Morningstar, Value Line, even checking out the company's own investor relations website. That can be huge. They're packed with info on financials, competition, performance, all that good stuff.
So it's like anything else, right? Do your homework before you buy. You wouldn't buy a car without checking under the hood, taking it for a spin, right?
Exactly. Investing's the same way. Got to do your research, understand those risks, then make the call. No jumping in blind.
And it's not about always being right either, right? It's more about avoiding those big mistakes, using that margin of safety, and diversifying to cushion those inevitable bumps in the road.
You got it. Graham really hammered that home. Value investing. It's a marathon, not a sprint. It's about playing the long game, focusing on sustainable growth, protecting your capital, not chasing those quick, flashy returns.
So we've really gone in depth on Graham's principles here. The whole investing versus speculation thing, the importance of the margin of safety, staying rational even when Mr. Market's throwing a tantrum. How do we actually apply all this? How do we take it from the page to the portfolio?
That's the million-dollar question, right? And that's what makes the intelligent investor so powerful. It's not just theory, it's a blueprint for action. It gives you the tools to become a smarter, more disciplined, and hopefully a more successful investor.
Absolutely. And if there's one big takeaway from today, it's this. Anyone can be an intelligent investor. No matter your background, your experience, these principles can help you make sound financial decisions, build that secure financial future.
It's not about being a Wall Street whiz or having some secret insider knowledge. It's about learning, applying these timeless principles and making them work for you, for your goals.
So as you're starting out, or even if you're a seasoned investor, think back to our conversation on the margin of safety. How can you use that concept in your own decisions, big or small?
Yeah, really let that one sink in, because understanding the margin of safety, that's not just about minimizing risk. It's about maximizing your potential, setting yourself up for long-term success. It's about uncovering those hidden gems and turning them into lasting wealth.
And for anyone looking to dive deeper, we'll have links to some fantastic resources in the show notes, including The Intelligent Investor itself. Definitely a must-read for anyone serious about taking control of their financial future. So, until next time, happy investing, everyone.